One bad trade on one account is a mistake. One bad trade copied across 10 prop accounts can end the whole operation. That's the part most traders miss. They think multi-account trading means more opportunity, more scale, more upside. But if every account takes the same trade at the same time for the same reason, you are not diversified. You're correlated. And when you're correlated, one bad decision doesn't stay on one account. It hits every account together. So copy trading multiple prop firm accounts isn't really about making more money. It's about controlling risk before one bad click, one tilt trade, or one news spike turns into 10 simultaneous breaches. In this video, I'll show you the real scaling mechanic. One master account, multiple prop accounts, per account sizing, a flatten-all kill switch, and daily loss lockouts. The tool we built for this is Centurion, part trade copier, part multi-account risk manager for NinjaTrader 8. But this is not a hype video. A copier does not create an edge, and it does not protect you from yourself unless the risk controls are armed before the session starts. The copier scales the decision. The risk manager protects the operation. That is the entire game. None of this is financial advice. Futures trading involves substantial risk of loss. Most funded traders lose their accounts, and you should test everything in simulation first. Now let's break down the machine. The appeal is obvious. If you have one repeatable process, why trade it on one account when you could run it across 5, 10, or 20? Instead of making 10 separate decisions, you make one decision and distribute it. One read, one entry, one exit plan, many accounts. That sounds powerful, and it is. But power is not the same as safety, and this is where most traders get it backwards. They think adding accounts makes the business more stable. But if every account takes the same trade, you haven't added stability. You've added a multiplier. Whatever your process already is, multi-account trading multiplies it. If it's disciplined and tested, scaling can amplify something real. If it's emotional or oversized, scaling exposes it faster than anything else. Multiplication doesn't care about the sign. So before you ask how many accounts you can run, ask a better question. Would I be comfortable taking this exact trade at this exact size on 10 accounts at once? If that makes you hesitate, you're not ready to scale. You're ready to test smaller. Say you do have multiple accounts, a few evaluations, and a couple of funded accounts. The beginner plan is, I'll just enter them manually. That falls apart instantly. Futures move fast, especially at the open. If your setup appears and you try to enter 6 accounts by hand, you're clicking through 6 order tickets while price is moving. The first fills at one price, the second a little worse, the third gets slipped, and by the 6th, you're running 6 different versions of the trade, each with different risk. Then the real danger, when you're wrong and need out fast, you're under stress clicking through account after account, trying not to fat finger the wrong size. That's not a process. That's operational chaos. Serious multi-account trading can't be built on manual clicking. You need one master decision distributed cleanly. That's the copier side. But copying a trade cleanly doesn't make it safe. It just means the trade is copied perfectly, and that includes your mistakes. A trade copier solves the execution problem. You place one trade on a master account, and it mirrors across your connected accounts. That's one of the 2 things Centurion does for NinjaTrader 8. You trade the master, Centurion distributes the trade. But here's the mistake most traders make. They think copying means cloning. It shouldn't. Sending the same number of contracts to every account can be dangerous. A small evaluation and a larger funded account should not always take the same size. If the master takes 5 contracts and a small account should only take 1 micro, blindly cloning that can blow the smaller account on a completely normal move. That's why per account sizing matters more than people realize. Good copying isn't whatever I trade here, copy it there. Good copying is, take this decision and size it correctly for each account. One account trades micros, another trades minis, another a smaller ratio, another is disabled entirely. The copier is a distribution system, not a decision system. It doesn't know whether your trade is smart or whether you're tilted. It distributes what you tell it to. So the question that matters is, what happens when the decision being copied is wrong? That's where the correlation trap begins. This is the hidden risk nobody talks about enough. When you copy one trade across 10 accounts, those accounts are no longer independent. They're perfectly correlated. Same trade, Same time, same reason, same directional exposure. When it works, it feels amazing. When it fails, they all fail together. There's no diversification, no account quietly doing fine while another struggles, no cushion. It's all of them at once. Most traders think multiple accounts means a bigger business. What they've often built is a bigger version of the same risk. One account having a bad day is one bad day. 10 copied accounts having a bad day can be 10 accounts hitting drawdown limits together. Because the copier doesn't just multiply your good trades. It multiplies your behavior, your hesitation, your revenge trading, your oversized entries, your inability to stop. A copier without risk enforcement is a very efficient way to destroy multiple accounts at once. That's why the most important feature in multi-account trading is not the copier. It's the circuit breaker. The copier scales the decision. The risk manager protects the operation. And that is the second half of Centurion. Here's where Centurion becomes more than a copier. Because in multi-account trading, you don't just need to enter across accounts. You need to stop across accounts, automatically, before emotion gets a vote, before a bad trade becomes a bad morning, and a bad morning becomes 10 failed accounts. Centurion lets you set daily loss limits and risk boundaries before the session starts. You define the rules while you're calm. Then if those rules are hit, Centurion can flatten positions, cancel orders, and lock the accounts out for the rest of the day. When you trade one account, a risk rule protects that account. When you trade 10 copied accounts, the risk rule protects the business. The disaster is never simply being wrong. You will be wrong. The disaster is being wrong, refusing to stop, and letting that mistake propagate across every account you control. That's why a flatten-all kill switch matters. If something goes wrong, a news spike, a runaway position, a wrong size, you don't click through 10 accounts. One button. Flat everywhere. Orders canceled. The bleeding stops. The copier is offense. The risk manager is defense. And you do not run offense at scale without defense. Now the correct sequence, because most traders get it completely reversed. They scale first and try to become consistent later. That's backwards. You don't scale to become disciplined. You scale because you already proved discipline. Step 1. Build one repeatable read on one account in simulation. Not 10 setups, one process you can execute consistently. This is where order flow matters, and it's what Imprint Flow is for. Surfacing imbalance, absorption, and delta, so you're not just guessing at candles. But the tool isn't a substitute for judgment. You still prove the read. Step 2. Define your risk before your upside. Risk per trade, daily loss limit, max contracts. What happens after one loss? After two? When you feel tilted? If you can't state those numbers, you're not ready to scale. Step 3. Prove the process on one account over a real sample, not one good morning. Step 4. Add accounts slowly, 2 before 5, 5 before 10, and feel how correlated risk behaves. Step 5. Arm the guardrails before every session, not after you're in trouble, because the worst version of you should never decide when to stop. Read, risk, proof, slow scaling, enforcement. Reverse that order, and you're not building a business. You're building a faster failure. Let me make it concrete. 2 traders, same copier, same market, same prop model. Opposite outcomes. Trader 1 spends months in simulation on one setup. She knows where she enters, where she's wrong, how much she risks, and when she stops. She doesn't add accounts because she's excited. She adds them because the process was tested. With per account sizing, daily loss limits armed, and the kill switch available. If she has a bad day, the system stops the damage. Trader 2 watches scaling videos and goes straight to 10 accounts. His process is a feeling. His sizing changes by mood. His risk limit is, I'll be careful. The first normal losing streak hits every account at once because they're copied. He gets frustrated, takes another trade, then another, then sizes up. Now the copier isn't scaling a strategy, it's scaling tilt. By the end of the day, he doesn't have one problem, he has 10. Same tools, different sequence. Trader 1 scaled a proven process. Trader 2 scaled hope. Never copy hope. Never automate hope. Prove first, scale second. Guardrails always. Follow the logic one more step. If you have a defined read, defined risk, account-specific sizing, a copier that distributes the decision, and a risk manager that enforces the boundary, then the last bottleneck is the human click. That's where automation comes in. At Imprint, we're building toward an automated execution layer that takes defined Imprint Flow style reads and executes them through NinjaTrader 8, with Centurion's risk controls underneath. Not a magic money machine, not a promise of profit. Automation doesn't create an edge. It executes a defined process faster and more consistently than a human, which means a good process can become more consistent, and a bad process can fail faster too. So the value isn't automation itself. It's automating something already proven, already sized correctly, and already protected by risk controls. And for early users, here's the part that matters. Anyone who gets Imprint within the next 60 days gets the automation upgrade free when it ships. Use the tools now. Lock in the next layer when it arrives. Test everything in simulation first. Don't automate what you haven't proven. The machine should enforce discipline, not replace it. Here's the responsible way to test this. Start in simulation, one account, one read, one risk plan, and track your results. Then add the copier and sim, and make sure every account receives the right size. Test micros to minis, test account ratios, test disabling an account, test flatten-all, cancel-all, and lockout. You should know exactly what happens before you ever go live. Then, if the process holds up, add accounts slowly. Not because you're excited, but because the data says the process is ready. And remember, the goal is not to press more buttons. The goal is to survive long enough for your process to matter. A good trading operation isn't built around the best trade. It's built around preventing the worst day from ending the business. Multi-account trading is a risk management problem first, execution second, scaling third. So here's the whole machine in one breath. Prop scaling lets you run one repeatable process across multiple accounts. A copier distributes the decision. Per account sizing keeps each account aligned with its own risk. But correlation means every account can win or lose together. So the real protection is the risk manager. Daily loss limits, flatten-all, cancel-all, lockout, a kill switch for the whole operation. The copier scales the decision. The risk manager protects the operation. If you want to start with the free tools, comment the word tape or go to imprint.ltd/free for the free order flow cheat sheet and a free NinjaTrader 8 indicator. If you want the full engine, the copier, the multi-account risk manager, per account sizing, kill switch, and lockout, go to imprint.ltd. And this week, use code USA40 for 40% off. Get Imprint in the next 60 days, and the automation upgrade is free when it ships. None of this is financial advice. Futures trading carries substantial risk of loss. Most funded traders lose their accounts. And you should test in simulation first. Don't scale hope. Prove the process, size it correctly, protect the operation, and then scale. Subscribe for the next one, where I break down how the funded account